Hi, Chapter 9, the second introduction to macroeconomics. The second, when we look at the table of contents, we see that what we have in this video is national income determination. Basically, we're going to measure national income by looking at the GDP. So the GDP will be a topic here in this video, but also in Chapter 10, we learn more about measuring GDP and the actual numbers. And then some business applications, predicting the business cycle. So understanding the business cycle, what is the business cycle about, and then predicting in order to profit from the business cycle, in order to profit from a business point of view, from the knowledge, okay, what do we expect that the economy is going to do next? What will be the next development in the economy? Macroeconomics examines the whole business cycle, the entire business cycle. So why not think of the economy, the macroeconomy, as one big market? The big advantage is that then we can take the things we learned in microeconomics and apply it to the aggregate level, to the macro level. We recall our circular flow of income, where on the right-hand side we had the injections, and these injections we also call total expenditure. It's about the private households, the consumption, the investment, government spending, and net exports, export minus imports. That's where we are not that consequent, to be honest. Aggregate demand, the total demand in an economy, is the definition we find in our book. And so let's think about aggregate demand as this aggregate from the four parts. Aggregate demand and inflation. Why do we talk about inflation when we think about aggregate demand, all the consumption, all the investment, all the government spendings, and so on? How is that connected to inflation? Let's have a look at the figure 9.6, where we see this relation. And when we analyze this graph, then we feel, okay, we somehow saw this graph before, because that's a graph. On the horizontal line you have the quantity, and on the vertical line you have a price. Only that the quantity in this case is GDP, all the goods and services produced within an economy in a given period of time. And now, what is the price of all the goods and services? The answer is relatively easy. There is no such a thing as the price of all goods and services. The only thing that we can take and that we can have a look at here is the price level, or the change of prices from one period to another. And that's at the end what we call inflation. And we abbreviate this typically by a capital Greek pi, whereas obviously the letter P is already taken by our prices. So pi gives us the change of prices over time. We can and we should label the axes. So that would be pi up here, and that is y, the national output that we in this case, or for which we in this case use GDP, gross domestic product, as a proxy. And we see that obviously there is a negative relation between output and price, the very similar negative relation that we analyzed in microeconomics. But why? Why should that be the case? Is that convincing? In fact, when we look at the parts of aggregate demand, one part is consumption, is us. So what happens to our spending if the prices go up? Yeah, and we might recall the last period when there was higher inflation. The answer is sort of straightforward. It is that we in fact spent less or bought less goods and services, just simply because we didn't have enough money. Everything was more expensive, and that might have led to buying fewer goods, not leaving into holidays and stuff like this. And that's the relation that we see here. The higher the price, if we have a a price level. Right? If we have a price level of, let's say, an inflation of 1% every year, with this 1%, there is the connection to a spending of whatever we do, 400 euro, and now inflation goes up to 2%. And in fact, we are going to reduce our spending, and we are no longer going to buy the goods that formerly were worth 200 euro because now we have to pay more for it, which gives us a sign here that it's not so much about the euro, but the real terms, the real GDP, the amount of goods and services that we buy. So something that will be important in all our macroeconomic, or most of our macroeconomic analyses, that this national output, this Y, represents or is measured on the one hand in monetary terms, in dollars, euro, and yen, whatever. But at the end, it wants to measure the real amount of goods, the real, we could also say, purchasing power. How many goods can we buy, and how does that sort of change? Our presentation gives us these definitions between real and nominal. Nominal prices are not adjusted for inflation. These are just the prices that we find on the price tags and that we have to pay. But real prices are adjusted for inflation, so it's the price increase minus the inflation. So if the price increases by 4%, but we have 4% inflation, then at the end the prices in real terms didn't change. They are still the same. We have to pay 4% more because all the prices, the whole inflation went up. And we will see that this also, of course, has to do with the question, did our income also increase by 4%? We come to this in a minute, talk about the supply. So real GDP represents the amount of goods rather than the monetary term, the amount of goods bought, typically in reference to a base year. When you talked about price indices in statistics, and also we are going to talk about price indices in chapter 10, then this is typically one base year, and we ask ourselves, what is the amount that we are able to buy? So back to our argument here, we said, okay, for consumption, we might imagine the prices are higher and we can buy, in real terms, we can buy less goods. The same holds, in fact, for investment of the firms, because at the end they have the same phenomenon. Building a new factory, buying a new machine is at the end something where we have to spend, where the firms have to spend money for. And if the prices are higher, then in real terms there will be less bought. Similar to government expenditure and also exports. Also people in other countries are going to buy less if the prices go up. So that's our inflation graph, or our inflation and national output graph, aggregate demand. And this aggregate demand, in fact, can now be analyzed and has similar reactions as we had in microeconomics. There might be circumstances under which the demand goes up, even if there's no price change. In microeconomics, we call this exogenous factors. And you might think for a moment, exogenous factors for demand. And we mentioned some, we said that might be the income is the typical, if our income increases, then we might buy more goods and services. On a macroeconomic level, that can be that we, for example, have immigration, that people come into our country. Now there are more people and they buy more without price changes, but there are just more people and they need more money in order to consume. That would be an effect, and like the exogenous changes, or it is an exogenous change, that leads to a shift of the demand curve, a right shift. And if we had an AD, aggregate demand number 1 before, now there is a change to aggregate demand number 2, which means that at the same price level, we're always talking about the price level here, not individual prices for goods. At the same price level, people buy more if there is this exogenous change. In fact, one relatively typical exogenous change that we are going to discuss this semester is a change in government expenditure. Because the government can decide to say, we would like to have more demand. We would like to stimulate the economy by spending more money. And in Germany, with the change of government in 2025, 24, 25, the new government made it possible to spend quite a lot of money in order to invest, we say, but in fact, if the public invests, if they buy new streets, if they invest into the railroad, if they buy new barracks and new tanks for the military, we all call this G, government expenditure, and not investment, because investment is defined as the investment of private firms. So if the government spends more money, that might lead to, or that typically leads to, the aggregate demand function shifting to the right. And that's the first notion of our discussion of economic policy that we are going to do relatively intensively in this class of macroeconomics. The next figure in our book illustrates this by directly saying, okay, the old one was aggregate demand 1 with G1, government expenditure, and now if the government spends more, then it might be G2, and that is the right shift of a demand curve. So that's for the moment what we want to analyze about demand. And in order to come to an equilibrium, of course, after discussing demand, aggregate demand, we need aggregate supply. And the question is, how does aggregate supply look like? Our figures 9.8 and 9.9 give us two possibilities there. And you might stop the video for a moment in order to read the text there, and then we can think about it. What is it that we believe? What is more realistic? The left-hand side or the right-hand side, where it says if prices increase faster than the wages? We're back, as it's sometimes said in podcasts when they go into an ad break or something like this. I don't know whether you made a break. I did, because I rearranged the screen. You can see here that this changed, and besides on the left-hand side the aggregate demand, now on the right-hand side there is this discussion about aggregate supply. And if you read the two texts, then I suppose you might have come to the same conclusion, that when it says here, if prices and wages adjust to keep real prices and wages constant, then aggregate supply is constant or is a vertical line. That would mean at the moment where there is inflation of 2%, 3%, there is something like an automatic mechanism that increases our income by 3%. So the scholarships go up, all the incomes, every firm, every government, and so on, pays automatically 2% more if there's inflation of 2%. And we all know this is totally unrealistic. It doesn't happen. That's why there are trade unions, and that's why they have to go every 2-3 years, whatever the period of negotiation is, to the employers and say, hey, people, prices increased. That's why we need more money. And the realistic thing, what we observe in the real world, is in fact that that wages do not go up with the prices, but there's a delay. It might be 2-3 years later, and it might as well also not be the same amount. You had 6% inflation, and the trade unions achieve 5% or even 6%, but in the meantime, people sort of had lower real income, because this is then not paid for the past, but only starting at a specific point. which leads most economists to the conclusion that this one, the upward sloping aggregate supply function, is the realistic function. Okay, and of course, if you're not convinced here, that's a thing that we can discuss in class. That's what sort of the videos are there for. You watch the argumentation, you think about it, and if you come to the conclusion, no, I don't think so, then you are very, very welcome to say this in class. Supply and demand, and there is no big surprise that we are going to bring these two together in a diagram that talks about the equilibrium, in this case, the macroeconomic equilibrium. And the story that is told now is not new. If we have this upward sloping aggregate supply curve and the downward sloping aggregate demand curve, they are going to intersect in that point that we call equilibrium, which means at this equilibrium we get the level of inflation that leads suppliers and demanders to the same plans, and there is an equilibrium national income. Let's say pi 0 and y 0, and you might recall our chapter is about the determination of national income. So that's our first step where we say, okay, the national income is determined by the price level, not the prices, or the price level of course represents the individual prices, but by the macroeconomic price level. Our figure 910 illustrates this. In equilibrium, the inflation rate pi equates aggregate demand and aggregate supply at the national output level of y. Moving this diagram up here, and at the same time recalling that the parts, the aggregate demand, we discussed this, but also the aggregate supply, we might imagine, can change. Yeah? We said there can be the change from one to the other, and also the aggregate supply curve might change in the one or the other direction. Also here, recalling what we discussed in microeconomics, that the most important determinant of a supply curve shifting to the left or to the right are the costs. So when we at the moment talk about energy costs, that it becomes more expensive or later less expensive to buy fossil energy from other countries or to produce energy, whatever, then that might lead to a left or right shift of the supply curve. And all these changes might lead to, or will at the end lead to, a reaction. So let's take the example aggregate supply and energy prices go up. That would lead to a lower aggregate supply. So a shift from AS1 to AS2. And when we look at this, then we see income goes down, inflation goes up to a new equilibrium that will be here. And we see that there is this downward movement of GDP. There's less production, less national income, which we can refer to and will refer to here in our model as a recession, just defined by y goes down. At the same time, we have inflation because the price level goes up from one to the other level. An inflationary recession as a result of an AS curve that shifts to the left. And if we check our book and our presentation, we see that there 4 situations are sketched. This one being the one that we have been discussing, just with a left shift of the AS curve and a deflationary recession. So what we observe are these 4 situations: inflationary recession, deflationary recession, inflationary boom, deflationary boom. So when there are changes, outside changes that we used to call exogenous or external influence, external determinants of the macroeconomic income or the national income, then GDP might go up, might go down, and this is typically also accompanied by a change in prices. And this GDP going up and down is what we typically refer to as the business cycle. as explained in figure 9.12 with a bit of an explanation. So that's our next step, that we want to talk about this business cycle and what does it mean for us, for you as future managers. Why should you be interested in the business cycle? And then a next question that we focus especially in chapter 10 is, how do we learn about it? How is it predicted? How can we foresee? How can we predict the development of the GDP, at least with a specific probability? And when we talk about this business cycle, when we focus on the business cycle, we on the one hand see the announced question, what can we as future managers learn from this? How can firms exploit this knowledge? And when we read this text here, we find some hints to this. And if you did so, you see, like highlighted here, business persons, managers at that point have to plan their decisions, their investment decisions, but also their portfolio decisions. So which goods to offer in which phase of the business cycle. In order to do this, let us clarify two things. Number one, the phases of the business cycle. A systematic approach and sort of idealized scheme of events or a time scheme of the cyclical ups and downs in the business development looks basically like this. Please note that what we have written here is the growth, the delta, the change in GDP from one period to another, typically from 1 year to another, but it might be measured in quarters, even sometimes in months. And then we can differentiate between an upward movement and a downward movement. Let's call them upswing and downswing. And it's not intended, that the downswing is a bit shorter than the upswing. Within these general periods, we typically differentiate 4 phases. It starts when the economy is down. Some people call it a trough, but let's say here we talk about a recovery as the first phase. We come sort of out of the trough and it goes upward, followed by a phase that we call expansion until we reach the summit or whatever. The peak is the typical term. And you might recall that our book used the term boom for this last phase. After this peak, we often face a slowdown of the economy that might end up in a depression if the economy really goes down. And that's what we can also call a recession. And if we number these phases from 1 to 4, then we come recovery, expansion in the upswing, and slowdown and depression in the downswing. Other names can also be used. You see here this from trough to peak, but also calling this phase a boom, and isn't necessarily only at the end here, but might already start here in the expansion. And the recession is basically the downward movement. A depression might still be at a point where we are not sure, where the scientists are not sure whether it might go up or not. That can happen, that the forecasts of the economic researchers say it might be minus 0.2, it might be 0, it might be plus 0.2. Let's see whether we finally can come out of the recession and go into a recovery period. Measuring this is the theoretical business cycle. Measuring this is something that we are going to do in chapter 10, where we look at actual numbers for countries, most importantly here for Germany, as the class takes place in Germany. Before we do this, let us make one important distinction. You might recall, you do please recall, that when we talk about a business cycle, that what we do, we talk about the growth, the change in GDP between periods. And that's a big difference that we often find neglected in publications, even in textbooks, that the development of the GDP over a time, let's say over the last decades, over the last 50 years or so. In Germany, we often look after World War II, so since the 1950s, is typically an upward movement that could be sketched basically like this, or let's say at the moment it's a bit slowing down, so we might go in this direction. But we typically observe an upward trend, an ongoing upward trend. If we take a bit of a closer look, we see that this upward trend doesn't hold in each and every year, which is of course not a very nice drawing, but you are in the meantime used to my wonderful drawings. But nevertheless, a general upward trend, and only in some years, if we talk about these 70 years since the 1950s, we might observe the oil crisis in the 1970s. 1980 was a crisis, then .com and the following at the beginning of the 21st century, and then we have sort of in the years after 2010 there was quite some disorder, you could say, or the growth slowing down due to the financial crisis, due to the COVID and the war in Europe and so on. But basically an upward sloping development. And this is totally different when we look in the lower graph when we talk about the growth. We already saw this sketch before, albeit of course somewhat different. But let's note that this is percentage change. That's why here we see numbers from 0, 1, 2, 3, 4, 5, whereas up here we have euro, we have dollars, and so on. So we have money, and we are talking about billions, trillions, quadrillions, whatever, of currency, whereas down here in a relatively slow range, 1, 2, 3%. And again, this drawing doesn't win a beauty prize, but it's typically what happened in the last decades. We had growth rates that were even higher, but let's say here 3%, in the 1970s were somewhere up 10% or so, but let's say in the last decades 3%, then going down, going up, going down. But what I'd like to point out here is that when we complain about the economy going down, a slowdown, a recession, and then being at a trough, and then going up again, that these troughs typically are positive. So here, this trough that I made would be at 0.5% growth. So we are normally not talking about real negative development, but more growth or less growth. That can, of course, happen, which I tried to do here. When you look at the financial crisis, then it really went down to minus 5% or so for a small period of time and then caught up relatively quickly. And we might be in a situation where the growth is low or where it's even down here. Germany experienced this in the 20s. Growth 0.2, something around the zero. But let us keep in mind whenever we talk about the business cycle that this slowdown, recession, depression, and so on that can be here, that can be and typically was in the Western countries in the last decades in a positive development, and that brought with it a strongly positive development of the GDP itself and these cyclical ups and downs of the economic activity when we do not draw GDP but delta GDP, the growth. And please kindly keep this differentiation between the two well in mind. And that brings us to the very last argument or outlook in our chapter 9.6, profiting from the recession. What can firms learn from the business cycle and how can they profit, or how can they bring this into their thoughts and plans and strategies? This is something I don't want to elaborate here on. What do income elasticities have to do with business cycles? What about pricing? What about costs? Why should portfolios be adapted? These are questions that we can discuss in class, and I hope that you think a bit about it and bring already some answers or some questions about these aspects. And then let's have a look what it is that we in a class of economics for business can profit, can learn from these economic analyses. As we said in chapter 10, we basically start at the very same point. We talk about GDP and the business cycle and so on, but with numbers. Chapter 10 is about measuring business activities. So from the theoretical thing that we did here, we are going to move on in chapter 10 to measuring the different macroeconomic variables. See you then.